$20,000 doesn't change how you feel about money. It changes how every financial institution in America is legally, structurally, and algorithmically set up to treat you. There is a Federal Reserve working paper from 2023 that classifies households along a spectrum from financially fragile to financially resilient. The cutoff the economists use isn't $100,000. It isn't $50,000. It's $20,000 in liquid savings. And here is the part that doesn't make the headlines. Banks run internal account profitability models, and those models have a name for customers below that line. They call them high engagement accounts. Translated from corporate speak, these are the people we charge the most. Your bank does not want you broke. Broke people can't pay anything at all. Your bank wants you almost okay. Precisely stretched enough to occasionally overdraft, precisely worried enough to never walk away from the product, and precisely distracted enough to never look at the math. $20,000 is the specific number that breaks that model. Today, I'm going to show you exactly how the model works, why it targets your specific income range with surgical precision, and what the math looks like once you've crossed to the other side. The toll road metaphor. Before we dive into the mechanics, I want to introduce a metaphor that we will use throughout this video because it cuts through the complexity better than any chart. Think of your bank as a toll road, not a modern, government-operated highway with clear signage, but the old kind from the 1800s. The kind where a private company owned the only bridge over a fast-moving river. They set whatever price they wanted because your alternative was swimming. The toll road owner didn't need you to be wealthy. If you were too wealthy, you'd buy the land and build your own bridge. He didn't need you to fail completely either. If you failed, you'd stop traveling and he'd lose a customer. He needed you almost okay. Productive enough to keep earning money, but stretched enough to keep needing the bridge. Every month, like clockwork, you showed up and paid the toll. $20,000 is the moment you build your own bridge. And the moment you do, the toll road operator loses his pricing power over you permanently. Layer 1. The engineered overdraft. Let's talk about the first layer of extraction, overdraft fees. In 2022, according to the Consumer Financial Protection Bureau, U.S. banks collected $7.7 billion in overdraft and non-sufficient funds fees. But here is the number that should stop you in your tracks. 9% of account holders paid 79% of all those fees. The bank isn't casting a wide net. It is targeting a specific demographic at a specific financial stress level. Banks use what are called transaction ordering algorithms. When you have multiple transactions pending and your account is about to go negative, the bank has a choice. They can process the smallest items first to minimize fees, or they can process the largest item first, like your rent, to ensure that every subsequent small coffee or grocery trip triggers a separate $35 fee. Wells Fargo paid $1.4 billion settling a class action suit over exactly this practice. It wasn't a glitch. It was a decision made in a product meeting. The toll road doesn't merely charge you. It engineers the optimal moment of the toll. When you have $20,000 in savings, you never overdraft. Not once. The algorithm has no entry point into your life. The toll booth is simply not on your route. Layer 2. The revolver versus the deadbeat. The second layer is credit card interest. In early 2026, the average American household carrying debt is paying roughly $1,300 in annual interest, compounding at 24% to 29% APR. The credit card industry has a secret classification system. People who carry balances and pay interest are called revolvers. They are the lifeblood of the industry. But people who pay in full every month and generate zero interest revenue, internal documents, trade publications, and conference presentations have a name for them. Deadbeats. The person who uses the points, enjoys the fraud protection, and refuses to pay a single cent in interest is a deadbeat. That should be your stated goal. You want to be the least profitable person your bank has ever met. But here's the trap. Without a $20,000 buffer, the credit card becomes your emergency fund by default. When the car breaks down, the card absorbs it. Because the card absorbed it, you can't pay the balance at the end of the month. Now, that emergency is compounding at 29%. You aren't paying for a car repair. You are paying a lifetime tax for the crime of being stretched too thin. Layer 3. The maintenance fee. Then come the account maintenance fees. The average monthly fee is now around $15. Banks waive this if you keep a minimum balance, usually between $1,500 and $5,000. Think about the cruelty of that mechanic. If you are struggling to build savings and you have one bad month, an irregular paycheck or an unexpected bill, your balance dips. Right when you can least afford it, the bank hits you with a fee for being financially vulnerable. It is a penalty for not having enough money. Once you cross $20,000, this fee vanishes forever. You're no longer charged for the privilege of letting the bank hold your money. Layer 4. The desperation premium. Layer 4 is what I call the desperation premium. A National Bureau of Economic Research paper found that borrowers under measurable financial stress pay 1% to 2% more on loan products than stable borrowers with the exact same credit scores. Lenders can sense when you aren't in a position to walk away. On a $30,000 car loan, that extra 2% costs you $1,600. It is an invisible tax on your weakness. When you have $20,000 in a high-yield savings account, you have outside option value. You walk into the dealership differently. You hold the silence longer after you make an offer. You aren't bluffing when you say you'll think about it. The lender knows you have your own bridge, so the price of theirs suddenly drops. Layer 5. The psychological tax, the 13 IQ point gap. This is the most expensive layer of all, and it never appears on a bank statement. In 2013, researchers from Harvard and Princeton measured the cognitive impact of financial stress. They found that chronic financial anxiety impairs performance by the equivalent of 13 IQ points. To put that in perspective, pulling an all-night session without sleep impairs you by about 8 points. Being worried about your bank balance makes you dumber than being sleep-deprived. When your brain is stuck in scarcity mode, you can't think about next year. You can only think about next Tuesday. You are more susceptible to impulsive purchases because buying something gives you a temporary dopamine hit to mask the anxiety. You accept worse terms because you don't have the cognitive bandwidth to shop around. $20,000 is the level where this low-grade fever of anxiety breaks. The 13 IQ points return, and with them comes the ability to slow down and make decisions that benefit the future you, instead of just surviving the current you. The story of Claire. Non-desperation as a currency. Let me tell you about Claire. Claire worked in marketing in Atlanta for 8 years. She had a manager who took credit for her work, dismissed her ideas, and passed her over for promotions. Claire saw it all, but she stayed silent. She had $6,000 in savings, a mortgage, and a kid in daycare. She couldn't afford to be difficult. Her manager had leverage over her, not because of a contract, but because of her bank balance. Then, Claire inherited $18,000 from her grandmother. She didn't buy a car. She didn't go on vacation. She put it in the bank. Suddenly, she had $24,000. Within 90 days, Claire's behavior changed. She didn't become aggressive. She became non-desperate. She started speaking up in meetings. She applied for other jobs. When she finally resigned, the company offered her a 23% raise to stay. She declined. Claire didn't get smarter. She didn't get more experienced. She just crossed a threshold where she was no longer a captive. Non-desperation is worth roughly 23% of your salary. The industry's best-kept secret. I once knew a branch manager named Derek. He told me that banks track contribution margin per customer. The most profitable customers weren't the millionaires. Millionaires are expensive to maintain. They want private bankers and custom products. The golden goose for a retail bank is someone earning $60,000 a year, carrying a small credit card balance, occasionally overdrafting, and keeping less than $10,000 in savings. That person is a predictable, recurring revenue stream. The industry marketed overdraft protection as a safety net. "We've got you covered," they said. But look at the math. It converts a declined transaction, which costs you $0, into a completed transaction that costs you $35. They named it protection and sold it as a feature. It is the only product in the world where the benefit is being charged 1,000% interest for a $4 cup of coffee. How to cross the bridge, the Ryan scenario. Let's look at Ryan. Ryan is 34, earns $68,000 after taxes, and has been stuck with $4,000 in savings for years. Every time he gets ahead, an emergency happens. Ryan decides to change one structural thing. He opens a high-yield savings account, HYSA, at a different bank. This is crucial. If your savings are in the same app as your checking, the friction is zero. You'll spend it. Ryan sets an auto transfer for $500 the day his paycheck hits. He never sees the money. Months 1 to 12, he hits $10,000. Months 13 to 20, he hits $20,000. The moment he crosses that line, the downstream effects kick in. His credit score jumps because his utilization drops. He refinances his car loan, saving $1,200. He raises his insurance deductible, saving $700 a year. Suddenly, Ryan is saving $850 a month instead of $500. Not because he got a raise, but because he stopped paying the poverty taxes. The complexity trap. The financial advice industry thrives on complexity. They want to sell you allocation frameworks, rebalancing schedules, and alternative assets. Why? Because they can't charge you a fee for telling you to save $20,000 and put the rest in a low-cost index fund. The S&P 500 has averaged about 10% annually over the last 30 years. If you put $100,000 in at age 35 and never touch it, by 65, it becomes $1.74 million. But here's the catch. You can only be a patient investor if you have that $20,000 buffer. Without it, you will be forced to sell your investments at the worst possible time during a market crash because you need to fix a leaky roof or pay a medical bill. $20,000 buys you the right to be patient. And patience is the only thing that actually builds wealth. Your 3-step action plan, I want you to do 3 specific things this week. First, calculate your extraction rate. Pull your statements from the last 12 months. Add up every overdraft fee, every cent of credit card interest, and every account fee. For most people under $20,000, that number is between $1,500 and $3,000. That is the price you are paying just for the privilege of being short on cash. Look at that number. That is your motivation. Second, create friction. Open a high-yield savings account at an institution you don't currently use. In early 2026, you should be getting 4% to 5% interest. Your current big box bank is likely giving you 0.01%. On $20,000, that's a $900 difference per year. Don't leave $900 on the table because you're too lazy to open a new app. Third, define your outside option value. Ask yourself, how many months could I survive if my boss fired me tomorrow? If the answer is less than 3, you are playing a bluff. You are walking through life with a weak hand, and everyone, your bank, your landlord, your employer, can smell it. Closing. The financial system is a masterpiece of engineering. It is designed to keep you in the high engagement zone, productive enough to work, but stressed enough to pay. The toll road is patient. It is well capitalized. It is fully optimized. It doesn't hate you. It just sees you as a contribution margin. Your job is not to fix the system. Your job is to build your bridge, cross it exactly once, and never look back at the toll booth again. The simplest path is usually the most effective one, but it is also the hardest because it requires you to ignore the dopamine hits of spending and the complexity of expert advice. Build the buffer. Become a deadbeat. Get your 13 IQ points back. Because the best thing money can buy isn't a car or a watch. It's the ability to walk out of any room where you aren't being respected. And that starts at $20,000. If this video helped you understand the math of the trap, hit subscribe. The algorithm is a system too. And one way to break its model is to make sure you keep seeing content that actually helps you grow. I'll see you in the next one.